My name is Caleb Lopez, and I'm Chief Investment Officer at University Wealth Advisors, LLC. Today we're going to discuss various financial terms, and we're going to discuss easy to understand definitions of various topics that I discuss with my clients. When I was doing my MBA, one of the books that I was assigned was this book called Virtuous Leadership. The author makes the case that leaders of organizations should ground their leadership style in the cardinal virtues. When I started University Wealth Advisors, I was inspired by this, and I wanted to add these cardinal virtues as it relates to wealth management to our firm's virtues and values. In order to get started, what we're going to discuss is our firm's virtues and values list. Whenever I created a corporate values list, I wanted to start with the cardinal virtues. And the reason being is because without having the cardinal virtues correct, a corporate values list is essentially meaningless. Various companies say things like, we value transparency, or we value innovation. But if you don't have the 4 cardinal virtues as the foundation of your corporate values, those things could end up becoming meaningless. For example, you could say you value transparency, but you could be transparently unjust. So for our first definitions, we're going to start with the cardinal virtues as they relate to wealth management. The first cardinal virtue is prudence. Prudence is the ability to make the right decision amidst complexity. Prudence means in wealth management using careful planning, research, and forethought to make investment and wealth management decisions for our clients. Using prudence means that we have to balance immediate needs with planning for the future when making decisions about our finances. The next cardinal virtue is temperance. Temperance is the ability to balance the desire for goods and our desire to attain material things. When it comes to wealth management, temperance means limiting and understanding your desire for wealth and material possessions and balancing that against other legitimate goods such as security, such as stability, and leaving funds for the next generation. Using temperance means helping clients make decisions about their wealth management in terms of what they value most, not solely chasing material possessions or ever-increasing values. The third cardinal virtue is fortitude. Fortitude is the ability to have courage in the midst of difficulty. In the context of wealth management, our clients are going to come across various difficult times in their finances. This could be an economic downturn, the loss of a loved one, or the loss of a job. We need fortitude in order to help our clients continue down the path of wealth management and wealth creation, even during difficult economic times. Finally, the last cardinal virtue is justice. Justice is being fair and giving to each person what they are owed based on their human dignity. We use justice in wealth management by being transparent and fair to each one of our clients and offering them recommendations that aligns with their values, not what's in the best interest of our firm. We root our corporate values in these cardinal virtues because they help us create a solid foundation when we're serving clients and helping them navigate their wealth management. After our firm's corporate virtues comes our firm's corporate values. If the virtues are the objective base of our firm's moral integrity, then the values are the subjective ways that we serve clients that are in our niche. The first is education. Every time that we interact with a client, it is the opportunity to educate them about some aspect of their finances. Our clients work in education, which means that they align with us when it comes to putting education as a top priority in their wealth management. Our next corporate value is excellence. Excellence for me means not missing any details and always doing a rigorous job to make sure that no stone is unturned for each one of our clients. Once I heard a story about a gentleman named Jose Maria Escriva. He was a Catholic priest and a gentleman who was teaching his spiritual followers about excellence as it relates to their work. To give them an example, he brought them into this grand cathedral, and they walked through the grand arches, the beautiful decorations, and the beautiful stained glass windows, and they went up to the attic of the cathedral. And what he was showing his students was that even in the attic of the cathedral, which in theory nobody or very little people would ever see, there was still fine attention to detail in those spaces that were not immediately visibly present to people who entered. I think of the same thing when it comes to our clients and their finances. We want to look at all of the little details so that nothing is getting missed. And even in those spaces and in areas in which you weren't expecting it, there is still excellence being brought to that area. Our last corporate value is transparency. Transparency means being completely open and honest when we work with clients. In the financial industry, it is not uncommon to find firms, advisors, or other operators who are not fully transparent. Fees might be hard to find, risks might not be fully disclosed. At University Wealth Advisors, we want to make sure that everything that we do is fully disclosed and understood by our clients, so there's open communication and we remain fully transparent. We hold ourselves accountable to very high moral and ethical standards so that we can help you create clarity in your wealth management. Next, as we move into various financial terms, we're going to take a look at some definitions and explanations for various topics that we typically are discussing with clients. The first and maybe most foundational thing that we work with clients on are their investments. When investing money for either retirement or some other financial goal, it's very important that you understand and you pay attention to your asset allocation. Asset allocation is dividing your investment portfolio into different asset classes. Usually, this is understood as a percentage of your entire portfolio. We may have clients in an asset allocation that is 25% large cap equities, for example, and we would have various percentages in these asset classes until it totals 100%. The reason this is the most important and one of the most foundational things we work with clients on is because depending on your goals, your asset allocation is going to be different. Sometimes people ask me, what is the best investment? What is the best asset allocation? They wouldn't necessarily put it in those terms, but that's what they're asking. What is the best asset allocation for me? What is the best investment for me? The problem is, without understanding you and without understanding your goals, that question is unanswerable. The best investment is not necessarily the one that makes the most money. You also want to adjust and account for things like risk. In modern portfolio theory, investors are seeking to find an asset allocation that is the greatest amount of return for the smallest amount of risk. That's why asset allocation can only be understood in terms of you and your goals and in your financial plan. For example, are you somebody who wants to spend all of your money in your lifetime, leaving nothing behind for either a next generation or a charity? Maybe you're more financially conservative. You want to save money and have more stability and not worry if there's an economic downturn or if there's some kind of market correction. The way we approach investments is actually going to do more with you than it is with me or my firm. This is why personalizing your asset allocation can be one of the most powerful and important steps in investment and wealth management. Now, within your asset allocation, you could have multiple different types of investments and multiple investment strategies. The two fundamental investment strategies are active investment management and passive investment management. Active investment management is the process of buying and selling certain securities based on economic factors in order to try to produce returns above a benchmark. Passive investment management is buying and holding various investments for the long term and not frequently trading based on economic activity. There is a long-standing debate in academic finance and in investment literature about which approach is better. The predominant academic financial theory about how to do investments is called the efficient market hypothesis. The efficient market hypothesis states that the market is information efficient, which means that all publicly available information is reflected in the price of securities, like stocks, bonds, and other types of financial instruments. For example, if a big tech company comes out with a revolutionary device and it's promised to change the way that consumers live and really increase the value of that company, as soon as that information becomes available, traders will purchase that stock and bid the price up to its natural market price. This is what it means for markets to be efficient. It's not that they are always perfectly efficient, but generally they're information efficient when it comes to the information publicly available. Based on that academic research, we can reason that active investment management is inferior to passive investment management. The reason being is because if the markets are information efficient, that means that it's very, very difficult to get an edge on the market when all traders are operating with the exact same amount of information. To summarize, within your asset allocation, you will have one of two investment methodologies, which is active or passive, and the efficient market hypothesis suggests that passive investment management is likely to be superior. Additionally, most research shows that passive investment management is likely to do better after fees than active investment management. The reason being is because of that efficient market hypothesis. Now, even though in the academic research, it is very, very clear that passive investment management is superior and that the efficient market hypothesis almost always holds true, some people have been critical of the efficient market hypothesis. There's this joke about the efficient market hypothesis. It goes like this. An economist and one of his students are walking down the street. They look and they see a $100 bill laying on the sidewalk. The student goes down to grab it, but the economist says, "Don't bother picking that up. If it were a real $100 bill, somebody would have picked it up already." People use this joke to describe one of the main critiques of the efficient market hypothesis, which is just because the markets are generally information efficient does not mean that there are not inefficiencies in the market that can be exploited. While I find the joke very funny, I do have one critique. The efficient market hypothesis does not state, as we had previously mentioned, that markets are always perfectly efficient. The saying goes, you would never judge an engine based on being perfectly efficient, but in its relative efficiency. So the efficient market hypothesis is actually saying, if you do see a $100 bill lying on the ground, you should pick it up. And you should pick it up very quickly because everybody else is walking around Wall Street looking for $100 bills to pick up. In recent news, a great example of this is NVIDIA. The other day, NVIDIA lost almost 17% in one day. The reason being, there was a Chinese competitor to NVIDIA that just launched a new AI tool named DeepSeek. As a result of this, NVIDIA lost 17% of its market cap. The reason being, DeepSeek offers an AI solution that is less expensive to maintain and would not require the same expensive chips that OpenAI requires that are manufactured by NVIDIA. Thus, with DeepSeek's announcement, the market drew back on NVIDIA stock. If you were a trader looking for inefficiencies in the market, it would be very difficult for you to take advantage of this drawback in NVIDIA stock. The reason being is because DeepSeek was announced to the entire world all at the same time. Only if you had insider information could you trade on this stock in order to make an outsized profit, which is illegal. The last term or concept that we want to discuss today are the university retirement plans that we work so often with clients on. Your university may have a retirement plan in the form of a 401A, a 403B, or a state pension plan. Very often I hear clients confuse these with other retirement vehicles. For example, I hear some people say to me that are employed by University of Michigan, for example, that they have a 401k. They do not have a 401k. They have a 403B. They may sound very, very similar, but they're actually different. A 403B is a tax-deferred retirement plan that is only available to nonprofit and state employees. A 401k is a tax-deferred retirement vehicle that is available to those who are employed by a private company. To make matters worse, both of these are different from IRAs, which are tied to an individual, not to an employer. Just the other day, I was talking to a client who was having issues with her tax software. She was doing her taxes and she had said that she had input the amount she had contributed to her IRA for the year. The problem was she had not contributed anything to her IRA. She had contributed to her employer's 403B. The tax software then was very confused and was giving her all sorts of angry messages but it's because of this fundamental misunderstanding of the differences between the various employer and individual retirement plans. Again, I appreciate any of you who have watched these videos. If you are interested in wealth management, specifically for university faculty and staff, you can always reach out to me at clopez@universitywealthadvisors.com, or you can visit our website at www.universitywealthadvisors.com. Now, bonus term, because I just thought of it in relation to university retirement plans. Inside of your university retirement plan, you may have something called a target date fund. This is a fund which purports to lower your risk in your investment portfolio as you reach retirement age. These are a great start for many people when they're starting saving for retirement. However, one thing to note with target date funds is they are very non-specific to you, the individual. This means that the plan administrator does not know you, your goals, or your other financial considerations, and is not tailoring that fund for your specific needs. In fact, they're tailoring it for the lowest common denominator, which would be you and everybody in your age cohort that may retire around the same time. But if there's one thing that I've learned in working with university faculty and staff, is that some of them do not retire at the typical retirement age. Some of them don't retire at all. I have some people who are still working at the ripe age of 72. I have some people who wanted to retire early and have done so. This is why tailoring your asset allocation, first term, back to the original term, tailoring your asset allocation to your specific goals is so important, and not relying on the university target date fund to accomplish your financial planning could be helpful. That's why it's important to understand your overall asset allocation instead of just relying on the university's target date fund to do your financial planning and your investment management for you.